Hello, I'm Nathan Kubik, and thank you for joining us for this intra-quarter capital markets update. Hopefully, everyone had the opportunity to view the quarter-end capital markets outlook. This discussion will expand upon that outlook and dive into what we've seen and done since quarter end. We've experienced a tremendous amount of upheaval in 2020. As a result, there has been significant volatility, and that volatility has created a number of market dislocations and market inefficiencies, or in other words, opportunities. We want to use this time to share with you how we have positioned to take advantage of these market dislocations and how we are currently positioned moving into the second half of the second quarter. So let's get started. Let's first focus on Transform Wealth's equity positioning from an overarching level. Here, we look at the major equity classes and how each has performed. As we've discussed, moving into 2020, we felt that the equity markets were a bit overvalued, but we were okay with that based on higher expected earnings growth in the latter half of the year. Obviously, we no longer think that's the case, and we saw and continue to see domestic equities as being more attractive than the rest of the world. And we've had virtually no exposure to international or emerging markets, which are depicted here in yellow and light blue. These indexes are trailing the domestic large cap space by nearly 10%. The dark blue line represents the S&P 500. Additionally, we saw considerably more strength in the large cap space than that of the mid cap or small cap markets, which are shown in orange and gray. These styles are trailing the large cap space by 10% and 15% respectively. As you are aware, we have been investing almost completely in the US large cap markets, which thus far has proven to be the optimal course of action. Over the long term, we will likely have exposures to each of these types of equities, but tactically we have been avoiding them, and we do expect to continue doing so until we see a fundamental shift in their underlying characteristics or a meaningful change in the market cycle. Let's look more specifically at how we have been positioning throughout this pandemic. Here, we look at our 5 largest tactical moves this year in our core equity model. The first move took place in early February. As the World Health Organization declared a global health emergency, we began shifting some of our underlying individual holdings towards companies with stronger fundamentals, better free cash flow margins, and greater relative strength. The second move occurred in late February. As it became apparent that the outbreak was spreading and that the economy could be impacted, we added a 5% hedge strategy to our equity model in an effort to reduce some of the potential market volatility. The third move occurred in early March. Here, we tactically repositioned by swapping some individual securities for others that we believed had a better risk-return profile for the current market conditions. The fourth move occurred in early April, and this one was arguably the most significant. As of April 1st, the equity markets as a whole had been beat up by more than 30% from the peak. Many of our clients were now underweight to equities, and we took this opportunity to bring them back to their target weights. In essence, adding more equity exposure near the bottom. In addition, we used this moment as an opportunity to make some meaningful shifts from a style and sector standpoint to position for current market conditions. The fifth move occurred in late April and early May. Following that fourth tactical move, the equity markets had an increase in about 14% of value, and we found that to be a bit more than was warranted. To that end, we repositioned about 10% of the portfolio in efforts to reduce our exposure to equity downside risk. We accomplished this through the sale of some fully priced securities and through the purchase of an additional hedge strategy and through some additional exposure to gold. In order to paint a picture for why we feel like the market may be a bit ahead of itself, let's take a look at this slide. As you can see, based on current earnings estimates, the markets are clearly overvalued. And this shouldn't be terribly surprising. For many companies, top line and bottom line numbers are much lower, but they will rise again once we are through this. That said, there is no denying that there has been significant economic impact and that we are officially in a recession. How the recovery looks is still a bit of an unknown. yet the market is only down about 11% year to date. The government and Federal Reserve have acted decisively and have given the country the best possible platform to come out of this. However, there are still many unknowns. It is certainly possible that the markets will continue to ignore the next couple of quarters of earnings and that the V-shaped economic recovery does occur. This would justify the valuations we are seeing today. While we are hopeful that this is the case, we simply believe that it is still too early to be certain. As such, we are positioned with some dry powder through that fifth tactical move to take advantage of any snags that may occur along the way. Let's now turn our attention to the fixed income markets. In mid-March, the Federal Reserve quickly initiated a Stage 1 quantitative easing program in response to the pandemic. They did so by cutting the Fed funds rate to zero. Treasury bonds typically move up or down relative to the Fed funds rate, but are also driven by supply and demand. As you can see in the chart on the left, this combination caused Treasury bond interest rates to fall dramatically. Let's look at the 5-year Treasury bond as an example. For anyone who was invested in them, they were being rewarded with a 1.69% yield. Not terribly attractive over the long run, but anyone who was holding them realized a year-to-date return of about 6.5%. For anyone that's still holding them, they're expecting a 0.31% yield going forward. Now that's not really attractive over the long run. In our quarterly reports, we use the Barclays Aggregate Bond Index as the benchmark for our income strategy. Looking at the chart on the right, we see the composite of the AG. As you can see, 73% of the index is made up of treasuries and other government-affiliated bonds. In truth, there's not really a perfect benchmark for the income strategy because most investors have not been willing to accept a 1.69% yield or now 0.31% for the government portion of that portfolio, especially knowing that the present values would devalue if rates were to rise. Of course, rates did not rise, they fell, and this was due to the cutting of the Fed funds rate and the flight to safety from the pandemic. While Treasury bonds rallied, investors hit the sell button on just about every other type of investment, including incredibly high-quality bonds. Looking at this chart, we see what happened to the Treasury yields in green. They declined pretty rapidly, and their prices correspondingly jumped. Remember that the price for a bond is just a time value calculation of future cash flows and principal repayment discounted at their market yield. In looking at municipals in red, we see something incredibly different than that of treasuries. The red line depicts the AAA municipal bond yields, which are the highest grade bonds out there. Here, we see an enormous market dislocation and buying opportunity that we discussed at length in an email we sent to every one of our clients. With this dislocation, we deployed any assets we already had targeted towards municipals. Through the email blast, we also asked if any of our clients were sitting on cash that should be deployed into this opportunity. And many clients did just that and have been rewarded. This dislocation quickly subsided and yields dropped meaningfully in a matter of days. Looking at the sharpness of the decline on that red line, we see where yields fell and prices rose. Looking at the corporate bond index, we see a similar story, but one that took a bit longer to unfold. Just like the municipal bonds, corporate bond yields rose and the bonds devalued. However, unlike munis, the corporate bond market has taken another month to work its way back to more appropriate relative values. But in the end, efficiency has returned to most of the investment-grade fixed income markets, and bond prices look more appropriate today as opposed to the end of the first quarter. Similarly to how we looked at our tactical moves in our core equity model, we wanted to do the same for our models in the fixed income markets. Here, we look at our 5 largest tactical moves we made this year in fixed income. The first move actually occurred before the beginning of the year. In the past, we have held a number of non-bond income-producing securities in our income model. These may have included dividend stocks, preferred stocks, high yield, master limited partnerships, emerging market debt, and others. Over the years, the profile of each one of these securities has changed, and the trade-off of credit risk for interest rate risk became unattractive. To that end, moving into 2020, our income model contained 90% investment-grade corporate bonds and 10% preferred stock. In this market environment, the lower the credit quality, the worse the performance. And this is boded well for our investment-grade bonds. Now that the market inefficiencies have subsided, this allocation has fared well for us and our clients. The second move, as seen with the yellow star, references the municipal bond market moves that we've been discussing. The third move, as seen in the blue, depicts a tactical move we made through the addition of more exposure to preferred equities. Preferreds did get hit relatively hard in early March. In our opinion, more than they should have. To that end, we increased our exposure from a near 10% to 15% to take advantage of some preferreds that we thought were beat up more than was warranted. The fourth move occurred in mid-April, and it consisted of a number of individual security moves to take advantage of opportunistic buying and selling opportunities. The final move just occurred in mid-May, and after preferreds rallied back to more appropriate levels, we took some of that risk back off the table by reducing that exposure slightly. We also shifted a bit of exposure to higher yielding mortgage-backed securities that we think still have some opportunity for their spreads to narrow. We hope this presentation has offered you some insight into the tactical decision-making processes of the investment committee, into the capabilities and systems at our disposal to be able to make shifts incredibly efficiently across all of our models for all of our clients, and the benefits of our in-house model-driven approach, which allows us to granularly control each of these risk exposures. In conclusion, while there are still many unknowns, each day brings us a bit more clarity and one step closer to coming through this difficult time. We remain focused on potential risk exposures and are prepared to reposition again should clarity of information shift risk exposures further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, please stay safe, and we look forward to speaking to you soon.